Hey, thank you for joining our recording today for Roth Employer Contributions for Owner Only Plans. My name is Kristen Pittman. I am the division leader for the Solo K Services team, and I will be your presenter. First of all, I need to disclaim that this information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional if you need legal or tax advice. Our target audience today is going to be primarily focused for our owner only DC plans with individually directed brokerage accounts. So for any plans that have employees or are with record keepers, this will not apply. This is only for our solo K plans with individually directed brokerage accounts. And we're targeting the plan sponsors of these plans for this presentation. So today I'm going to talk about Roth and go over what a Roth contribution is. Next, we'll go into what a Roth employer contribution is, the requirements for making these, and also the reporting requirements. So let's talk about what a Roth contribution is, first of all. Roth 401k has been around for quite some time. They're very comparable to a Roth IRA, but there are no income limits. They're after-tax contributions that go into the 401k, and they do not have a separate limit that are subject to the IRS limits. It's included with the deferral limit. So the IRS sets limits each year for deferrals. So let's say you make Roth contributions and pre-tax, you have to combine those two to make sure you do not go over the IRS limits for that particular year. For example, if we're looking at 2025, the limits for deferrals are 23,500 if you're under age 50. For age 50 and above, it's 7,500 for an additional catch-up. And age 60 to 63, it's an additional 11,250 for catch up. So you would need to combine the Roth and the pre-tax to ensure they do not exceed those IRS limits. Next, let's talk about how the 401k are taxed. So employee contributions are made with after-tax dollars, meaning that these monies that go into the plan as Roth have already been taxed. So they have to be record kept separately from the pre-tax dollars because the distributions have different requirements on them when you take a distribution from a Roth versus pre-tax. So a Roth has to be qualified in order to take it out as a distributions that are tax-free. What does qualifying mean? Qualifying means that the Roth has to be in the plan for at least 5 years. Also, the IRS prohibits deferrals being distributed from the plan prior to age 59 and a half. So you must be age 59 and a half. And also, if you have a death or disability event, then that would qualify for qualifying distributions. As long as they are qualifying distributions, they are tax-free. So they are record kept separately. Let's look at the little flow chart we have comparing the two. We've got Roth 401k versus traditional pre-tax 401k. So a Roth 401k has been taxed before it's taken out of earnings. It has already been taxed. Once it's taxed, it's deposited into the 401k plan. Then at the time of retirement, when it's distributed, it's tax-free. versus the pre-tax. The pre-tax is not taxed before it comes out of income. It's just taken directly out of income, deposited into the 401k. Then at time of retirement, it becomes taxable income. So now let's switch over to the Roth employer contributions and talk about what that is. So the IRS now allows you to make an irrevocable election to treat any employer contributions as a Roth contribution in your account. Let's talk about what do we mean by employer contribution? Employer contribution can be a profit sharing or a match. These are any type of employer contribution is going to be deductible to the company. So it's a company deduction. That is the differentiator between the employer and the employee. The Roth contribution, sometimes called Roth ER, made on after-tax basis. This is included in gross income for the tax year in which the Roth ER is allocated. So very important to note, if you do elect these and you make a contribution in 2025, you make the deposit in 2025, it's going to be taxed for 2025 tax year. So in this example, I have the 2024 profit sharing contribution is deposited on 4/12 of 2025. That amount will be taxable for the 2025 year. So in 2026, you will have a 1099-R generated for 2025 for the amount that you elected as a Roth contribution into your account, the date it was deposited. This is not considered compensation for any other plan purposes. So distributions have the same tax treatment as Roth elective contributions. So it's very important to note that these types of transactions require a 1099-R. This is a taxable event, so it has to be reported. So you have to provide the data to NOVA so that we can get our vendor to prepare that 1099-R. And again, it's reported the year it's deposited into your account, not by the plan year. We do recommend that you consult with a CPA on making estimated tax payments to avoid any underpayment. So what are the next steps? If you're interested in the Roth employer contributions, you first need to complete an irrevocable salary reduction form. This form should be kept in your permanent records. NOVA does not need a copy of this. This is for your plan records in the event you're ever audited. The auditor would be looking for an election form for these. The next step is to complete the employer election form once the deposit is made. So you don't need to fill that form out until the deposit is made, because you have to report the amount of the deposit and the date it was deposited. These forms must be returned to NOVA so that we can have our vendor prepare the 1099-R. So if you have any questions or you're interested in this transaction, please reach out to our Solo Case Services team and we can provide these forms for you. If you've already completed an irrevocable salary reduction form in a prior year, then all you'll need to do is complete that employer election form once you have made that deposit. There are additional fees that apply to these transactions. To prepare that 1099-R, we do charge $125 per transaction. So if you have multiple people in your plan making these Roth employer contributions, then you would be charged for each transaction. It's per transaction. Also, we have to record keep this money type separately. So when we prepare the annual valuation for your plan, we have to separate that money source and account for it separately and reconcile it separately. So there is an additional money source fee of $100, which is charged annually. I hope this provided some great information for you. Please feel free to reach out to our team at either 713-881-9350 or email us at solok at nova401k.com. We're happy to help you. Thanks for joining today.